कॉन्ट्रैक्ट बेसिस। कहाँ रहते हो?
रहते दिल्ली में।
हाँ,
ये मीत नगर यमुना बिहार से
तो दूर है।
18 किलोमीटर।
अच्छा, अब आगे चले जाओगे तो और दूर हो जाओगे,
हाँ फिर कहीं और देखेंगे।
क्योंकि अब तो ये वन नॉलेज पार्क जाने की बात कर रहे हैं ना। ये मेरी थी इकोनॉमिक्स का क्लास।
क्या खत्म
कोई बात नहीं। थैंक यू। शुरू करें?
हाँ
Yes, friends. Today we are discussing block 3, financial market. Market is conventionally defined as a place where buyers and sellers meet to exchange goods, services, or financial products and instruments for a consideration. The markets may be classified as follows: product market, where goods and services are traded; factor market, where labor, capital, and land are exchanged; and financial market, where financial claims are traded. A financial market is a system of processes and functions that are usually regulated by means of rules and guidelines for enabling participants to transact in financial products and instruments, that is, financial claims. The financial markets are markets crucial in promoting economic efficiency by channelizing funds from those who do not have immediate requirements for funds to those who require them from productive purposes, or you may say from savers to investors. In these markets, financial assets such as stocks and bonds could be sold and purchased. They facilitate the flow of funds for financing and investing by households, firms, and government agencies. Role and functions of financial market. The financial market is a place or mechanism where funds or savings are transferred from surplus units to deficit units. In the absence of financial markets, it is difficult to transfer funds from a person who has no investment opportunities to one who has them. The financial markets are thus essential to promote economic efficiency. Flow of funds from lenders to borrower. The figure which I am just going to show is a some simplified form of flow of funds from ultimate lenders to ultimate borrowers, or you may say from saving surplus units to saving deficit units. The flow of funds moves from left to right, either directly through financial markets or indirectly through financial institutions. This is the chart. Here are the ultimate lenders, here are the ultimate borrowers. Direct finance is through financial market and indirect finance is through financial intermediaries or financial institutions. The financial markets not only help in the fast growth of industry and economy, but also contribute to the society's well-being by raising the standard of living. Thus, the financial markets play a significant role in the allocation of the savings, in efficient production of goods and services, and assist in achieving the desired national objectives. Functions of financial markets. The functions of financial market can be classified into three categories: economic functions, financial functions, and other functions. Economic functions. It facilitates the transfer of real economic resources from sellers to ultimate users of economic resources. Lenders, investors earn interest or dividend on their surplus investable funds, thereby increasing their earnings and as a result enhancing national income. Finally, borrowers generally use borrowed funds productively if invested in new assets, thereby increasing their income and gross national products. Finally, by facilitating transfer of real resources, it serves the economy and finally the welfare of the public. It provides a channel through which new savings flow into capital formation of a country. Financial functions. It provides the borrowers with funds which they need to carry out their plans. It provides the lender with earning assets so that their wealth may be held in a productive form without the necessity of direct ownership of real assets. It provides liquidity in the market through which the claims against money can be resold at any time and thus reconverting them into current funds. Other functions. Price discovery means what is the price for a particular investment. Liquidity. The funds must be in the liquid form. For example, if you are investing in the mutual fund, you can convert into cash within a period of 2 or 3 days. It reduces cost. It reduces the search, that is the explicit cost, and information cost, which are the implicit cost of transacting. Types of financial markets. The financial markets comprise of all banking and non-banking financial institutions. Procedure and practices followed in these markets and financial instruments for facilitating the flow of funds. The classification of financial markets in an economy is shown in following figure. Financial markets are divided into two parts: organized market and unorganized market. Unorganized market, money lenders, indigenous bankers, etc. Organized market has got two parts: capital market and money market. Money market includes call money market, commercial bill market, treasury bill market, short-term loan market. While capital market includes industrial securities market, government securities market, and long-term loan markets. These securities market are divided into primary and secondary market, and long-term loan market is divided into term loan market, market for mortgages, market for financial guarantees. Now we will discuss them one by one. On the basis of the period of maturity of the securities traded, the markets are classified as money markets and capital markets. These markets are again classified as primary market and secondary market. Money market. Money market is defined as a market for overnight to a short-term money and for financial assets that are close substitute for money. Short-term means a duration of less than or equal to 1 year. The Indian money market is divided into organized and unorganized markets. Unorganized markets, as I have just told you, consist of indigenous bankers and money lenders. They are outside the control of the central bank or Reserve Bank of India. The rates of interest differ in the organized sector from those in the organized sector. The banking system is the most dominant force in the Indian money market. Capital markets. Markets that facilitate the sale of long-term securities by deficit units to surplus units are referred to as capital market, and the securities traded in these markets are known as capital market securities. Major functions of capital markets are: they improve the efficiency of capital allocation through a competitive pricing mechanism. These markets lower the cost of transactions. They encourage broader ownership of productive assets, mobilize long-term savings to finance long-term investments, provide risk capital in the form of equity or quasi-equity to entrepreneurs, disseminate information efficiently, facilitate price discovery of financial instruments, risk management to mitigate against market risk, or you may say price volatility, enable wider participation, improve integration between different markets and different asset classes, real and financial sector of the economy, long and short-term funds, private and government sectors, domestic and external funds, support direct flow of funds into efficient channels through investment, disinvestment, and reinvestment. Capital markets can be classified further into primary and secondary markets. Primary market is a segment of capital markets that deals with the issuance of new securities, maybe share capital or maybe debentures. Secondary market is the segment of capital markets relating to trading of already issued securities. Secondary markets usually follow either an auction-based system or dealer-based system. While the stock exchange is part of an auction market, OTC or over-the-counter market is a dealer-based system. Exchange markets are organized trading platforms whereby buyers and sellers can transact. It is an organized marketplace with rules and regulations for trading in financial products and instruments. Over-the-counter markets is largely a direct market between two counterparties who know and trust each other. Contracts are directly negotiated, tailor-made for the needs of the parties, and are often not easily reversed. Debt markets involve issuance, trading, and settlement of fixed income securities, such as bonds of various tenors. Debt market instruments can be issued by central and state government, public sector units, statutory corporations, banks, financial institutions, and corporate bodies. Government securities market or GSEC market commands over 90% of the volume of transactions in the debt market. It is the principal segment of the debt market in India. Some of the important segments of the debt market, as I told, the first one is GSEC market. These are sovereign, or you may say credit risk-free, coupon-bearing instruments which are issued by Reserve Bank of India on behalf of the Government of India. Corporate debt market. In the last decade, several innovations have taken place in the corporate bond market, such as securitized products, corporate bond scripts, and a variety of floating rate instruments with floors and caps. However, the secondary market has not yet developed in the debt segment of the Indian capital market. Debentures are a type of financial claims issued by a company. The buyers of debentures are the creditors of the company who have invested capital in the company. Bonds refer to negotiable certificates evidencing indebtedness. It is normally unsecured. Various types of bonds are zero coupon bonds, means bond issued at a discount and repaid at face value, means there is no interest is paid. The difference between the issue price and redemption price represents the return to the holder. Convertible bonds, a bond giving the investor the option to convert the bond into equity at a fixed conversion price. Callable bonds. This provides flexibility to the company to redeem the issued outstanding bonds on a specific future date. Putable bonds. This provides flexibility to the investor to seek redemption of the bonds that she has purchased on a specific future date. Derivative market. Financial instruments that derive their value from underlying assets are commonly referred to as derivatives. When the need arose to mitigate risk due to the vagaries of commodity prices, derivative instruments were developed. Commodities market, a market where commodities are traded, is referred to as a commodity market. These commodities include bullion, means gold, silver, platinum, palladium, etc., ferrous, steel, and non-ferrous metals, copper, zinc, nickel, lead, aluminum, tin, etc., or energy products, crude oil, natural gas, heating oil, gasoline, etc. Agricultural commodities, refined soya oil, pepper, palm oil, coffee, pepper, cashew, almonds, etc. Existence of a vibrant, active, and liquid commodity market is normally considered as a healthy sign of development of country's economy. Foreign exchange market, in India is regulated by Reserve Bank of India. Guidelines have been established for trading in foreign exchange. Limits have been clearly specified by the RBI for investment abroad and the policy for purchase of foreign exchange when an individual is traveling to a foreign country or for any other purpose. Other markets includes loan market, insurance market, retirement savings market, mutual funds, and savings and investment markets. Participants in money market, the most important one, central bank of the country. Here in India, Reserve Bank of India. It participates in money market by issuing currency notes, by working as an agent to the governments, by acting as bank's bank, by maintaining adequate foreign reserves. Commercial banks. The other significant participant in the money market of a country is commercial banks. The different ways in which the commercial banks participate in the money market are by assisting in mobilizing the public savings, by meeting the short-term working needs of the business, by providing a range of other services in the capacity of agent for their clients, by collecting the amounts origin due to interest, dividend, rent, salaries, wages, commission, etc. for their clients, for their customers, by advising their clients relating to sale and purchase of various securities and in designing their investment portfolio so that the customers may gain to the maximum. Indigenous financial agencies are important participants in money market, especially in unorganized sector. They comprise of money lenders and indigenous bankers. In spite of a lot of controls which the government has tried, they are still there and they are the main sources, especially in the rural area. Discount houses. Discount houses are important constituents of the money market. The major function of these houses is to discount trade bills of traders to provide adequate liquidity in the market. Acceptance houses. Another important participant in the money market is acceptance houses. They played a significant role in providing more liquidity in the money market through borrowing short-term loans from the banks and lending the same to the traders. Now participants in capital market. These institutions can be classified in two categories: banking institutions and non-banking institutions. Some of these institutions may be directly participating in the capital markets, while others may be indirectly connected by way of providing intermediation services to the companies. For example, investors, stockbrokers, and others. Banking institutions, they directly participate in the services. The various forms of banking institutions are commercial banks, cooperative banks, land development banks, foreign banks, regional rural banks, etc. Non-banking financial institutions, apart from some banking concerns described above, a lot of economic activities are performed by the other financial institutions which are of non-banking nature. They are investment banks, merchant banks, investment companies, insurance companies, development banks, pension funds, private sector, finance companies, etc. Sources of finance. The funds are required basically for two reasons.
कट
One, to
लगा
acquire fixed
मैं
assets, and other, to run the operations of the business. It is imperative for any organization to raise funds for the smooth and effective functioning of the business. As I have just told, business usually needs two kinds of finances: long term and short term. Long term to acquire fixed assets, and short term to run the operations of business. The quantum of finance needed may depend on several factors: nature of business, scale of operations, business cycles, assets structure, etc. There are different sources for raising capital for different purposes. Classification of source of finance: long term, medium term, and short term. As per the ownership and control, it is classified as own funds and borrowed funds. Depending upon the source of generating this fund, either internal or external. Each of these sources has been further classified, and I have prepared a chart or table for your purpose. And according to time, they are long term, medium term, short term. Long term includes, the list is given, which we will discuss just now. From the ownership point of view, we have got owned capital and borrowed capital. And from the source of generation point of view, we have got internal or external. Now I will discuss each and every source in detail. Long-term sources. The long-term finance is raised when the needs for fund is more than 5 to 10 years. Long-term finance is required for acquisition of fixed assets having a life of more than 1 year, or investments which have long-term impact on the earnings of the company. Long-term sources are the first one and the most important one: equity share capital. It is one of the most important sources of raising capital, and which is must for every corporate body. Equity capital represents the owner's equity, which is prerequisite to start a company. Its holders are residual owners who have unrestricted claim on income and assets, and who enjoy all the voting power in the company, and thus can control the affairs of the company. It is perpetual in nature. Equity share capital is also known as risk capital, as the equity shareholders are exposed to greater amount of risk, but at the same time they have greater opportunity for getting higher returns. Preference shares. The preference shares are called quasi-equity, having characteristics of both equity and debt. They are equity as they are called share capital, and the payment, the dividend, is just like the payment of interest. Therefore, they are both equity and debt. These shareholders get dividend, which is fixed and paid before anything is paid to equity holders, but they do not have voting rights. Debentures. Debentures are one of the principal sources of funds to meet long-term financial needs of companies. Though there is no specific definition of debenture, according to Companies Act, the word debenture includes debenture stock, bonds, and any other securities of a company. Retained earnings. The companies can raise funds from internal sources through retained earnings, which are plowing back of profits for future expansion or diversification activities. We have already discussed the cost of these sources in the last counseling session. Venture capital. Venture capital is usually in the form of equity or quasi-equity instruments in a new company set up to commercialize a novel idea. It is investment at the early stage in case of high growth projects which have high risk with the potential high returns over a period ranging from 3 to 7 years. The risk factor being high, the probability of failure is also high. The venture capital investment is hands-on investment. Leasing. Leasing provides an alternate method of financing the business to acquire assets. Instead of borrowing for acquiring assets, it is possible for firms to acquire the assets on lease. A lease is a contract whereby the owner of an asset, the lessor, grants to another person, the lessee, exclusive right to use the assets for an agreed period in return for the payment of a rent called lease rental. Now this leasing is becoming very normal in case of even big companies. Hire purchase is another method of acquiring a capital asset for use without paying its price immediately. Under hire purchase arrangement, goods are let on hire. The hirer is allowed to pay the purchase price in installments and enjoys an option to purchase the goods after all the installments have been paid. Short-term sources. Firms also raise short-term funds from banks and other investors. Some of the methods used to raise short-term funds are trade credit. Trade credit is used by companies as a short-term source of financing. It is a credit facility extended by one trader to another for the purchase of goods and services. Immediate payment is not required in this case. Normally, you can say the selling goods on credit is known as trade credit. Commercial paper, CP. Companies with goods credit rating can raise money directly from the market by issuing commercial paper. It is an unsecured instrument through which high net worth corporates borrow funds from any person, corporate, or unincorporated body. It is issued in the form of U-cents promissory notes, which is freely transferable by endorsement and delivery. Its minimum period of maturity 15 days and maximum period any period less than a year. It is issued at a discount to face value, which is really the return of the CP. Factoring. The factoring is essentially a management service designed to help firms better manage their receivables. It is, in fact, a way of offloading a firm's receivables and credit management onto someone else. In this case, the factoring agency or the factor. Under a typical factor arrangement, collects the accounts on the due dates, effects payments to its client firm on these days, and assumes the credit risks associated with the collection of accounts. For rendering these services, the factor charges a fee, which is usually expressed as a percentage of the total value of receivables factor. Factoring service can be classified as non-recourse factoring and recourse factoring. In non-recourse factoring, the factor assumes the risk of debts going bad. The factor cannot call upon its client firm whose debt it has purchased to make good the loss in case of default in payment. In case of recourse factoring, the factoring firm can insist upon the firm whose receivables were purchased to make good any of the receivables that prove to be bad and unrealizable. Fixed deposits or public deposits, which are also have become attractive for companies as well as investors. For the companies, public deposits are easy form of fund mobilization without mortgaging assets. For the investors, public deposits provide a simple avenue for investment in good and popular companies at a better rate of interest without many formalities as involved in the case of shares and debentures. But the public deposits being unsecured, the repayment of deposits and regular payment of interest are subject to a lot of uncertainty. Financing through financial institutions. A company can also source long and medium term loans from financial institutions. These institutions are term loan, are granted for medium and long term, generally about 3 years, and are meant for purchase of capital assets, for the establishment of new units, and for expansion or diversification of an existing unit. Bank credit. Banks, including the development finance institutions, have become chief source of fund to the corporate sector. The banks extend credit to industries and commercial establishment at varying rates of interest depending upon the creditworthiness of the borrower as well as the period of the loan. Forms of bank credits are overdraft. This facility is allowed to the current account holders for a short period. Under this facility, the current account holder is permitted by the banker to draw from his account more than what stands to his credit. Cash credits. Cash credit accounts for the major portion of bank credit in India. The bank prescribes a limit called the cash credit limit, up to which the customer borrower is permitted to borrow against the security of tangible assets or guarantees. Bills discounting. The bills discounting is an important source of financing, trade and business. Under this form of financing, seller of goods draws a bill of exchange on the buyer, who accepts and returns the same to the drawer. Subsequently, the seller of the goods discounts the bill of exchange with bank or finance company and avail the finance accordingly. Parties to a bill of exchange are the drawer, means who has written the bill or who is actually lender. The drawee, on whom the bill is written, or actually who has taken the loan, the payee who will get the payment, the endorser, and endorsee. If the bill is endorsed to somebody else, who will become payee? Then the person who is endorsing the bill is known as endorser, and the person to whom the bill is endorsed is known as endorsee. If the bill is negotiated to several persons, the person to whom the bill is endorsed in turn becomes an endorser. The endorser is liable as a party to the bill. If the bill of exchange is not endorsed, then drawer and payee will be the same person. Letter of credit. A letter of credit is a written undertaking given by a bank on behalf of its customer, who is a buyer, to the seller of goods, promising to pay a certain sum of money provided the seller complies with the terms and conditions given in the letter of credit. It is generally required when the seller of goods and services deals with unknown parties or otherwise feels the necessity to safeguard his interest. Emerging sources of finance. Technology has led to development of newer means and ways of financing businesses, some of which are these. Assets securitization is fairly a simple process through which an asset, fixed or current, is converted into financial claim. In other words, it brings liquidity to an illiquid asset. The concept is very popular in housing finance. Under securitization, an intermediary agency is created which initially buys the illiquid assets and against that it issues securities which are tradable in the market through listing. Thus, it is also called assets-backed securities or mortgage-backed securities. The value of the security is improved by taking credit rating and often through insurance cover. Angel financing. A new startup business can flourish only if it is backed by sufficient funds. Companies finance their businesses using own capital and borrowed funds. There are individuals who invest in companies which are in their initial stages of development for equity ownership interest known as angel investors. These investors mostly look out for the quality, passion, and integrity of those who are starting the business, market opportunity, clearly thought out business plan, interesting technology, intellectual property, etc. Crowdfunding. In today's time of social networking, Facebook, WhatsApp, etc., many new ways have emerged for raising funds, and crowdfunding is one of them. It is an internet based mechanism where startups looking for funds and the potential investors can transact. It is a practice of raising funds using multiple websites from multiple funders. This gives budding entrepreneurs an opportunity to raise funds without spending significant capital. A company desirous of raising funds needs to create a profile on the website giving details about the company, its product or services, the amount that is being raised, etc. Those who are interested in it donate funds, usually in exchange of reward, a consideration. Small business credit cards, for example, Kisan credit card. Business credit cards are just like the normal credit cards that are available. These cards are, however, provided to business owners, giving an easy access to revolving credit with a set credit limit to make purchase and withdrawals. It increases the purchasing power of the company, but interest is charged if the payment is not made in the billing cycle. It is a convenient and easily accessible source of short term finance to meet the immediate needs of business. Capital structure. Finance is a critical input for any organization since it is required for both working capital and long term investment. The total funds used in a firm come from a variety of sources. And these sources, when combined, they become capital structure. Or you may say the mix or proportion of different types of finance, debt and equity is referred to as capital structure. Capital structure planning. The construction of a suitable capital structure in the context of each firm's facts and circumstances is referred to as capital structure planning. A company's capital structure should be planned in such a way that it maximizes its benefit and allows it to react more quickly to changing situations. Features of an appropriate capital structure, which should be there in every capital structure: profitability, solvency, means at any time there should not be the chances of insolvency, and flexibility. Determinants of capital structure: leverage or trading on equity, that is financial leverage, this I will just explain, and cost of capital. Cost of capital, which we have already discussed in the previous counseling session. Cash flow. Conservative is one of the characteristics of a healthy capital structure. Conservative does not imply the avoidance of debt or the use of minimal amount of debt. It has to do with determining the obligation for fixed charges, as well as the use of produced debt or preferred capital. Control. When it comes to capital structure design, the management sometimes guided by its desire to maintain control over the company. And the flexibility. The capital structure should adjust to the changing situation, which is known as flexibility. Size of company. The availability of funding is heavily influenced by the size of company. It might be difficult for a small business to obtain long-term financing. Marketability. Company's ability to sell or market a security in a given time frame. Flotation cost, which is again important in case of small companies. For big companies, it does not matter. Financial leverage. The word lever means inducing or compelling. The action of a lever or the mechanical advantage acquired by it is referred to as leverage. What is financial leverage? I am explaining it with the help of one example. Suppose company intend to buy a fixed assets worth rupees 80 lakh, which it can finance either by capital or 30 lakhs by capital or 50 lakhs in the form of loan at the rate of 18%. Minimum return 20%, rate of tax 40%. I have explained it in the next table. If the whole 80 lakh is financed through capital, as the earning on assets is 40%, 32 lakhs, and that will also in the both cases. But in this case, the interest will be paid on 50 lakhs at the rate of 18%, 9 lakhs. Now, earning after interest is here 32 lakhs, here it is 23 lakhs. Rate of tax is 40%, means 12.8 lakhs here, 9.2 lakhs here. Earning after tax is here 19.2 and here 13.8. But EPS is here 24%, here 46%. This is the benefit of getting loan because the loan has the benefit of savings in tax. You might have heard that the business is done by the money borrowed from others. This is financial leverage. Effect of financial leverage is on earning per share. Earning per share is divide earnings. What is the earning? After interest and tax by total equity to get earning per share, which is in this example 24% and here it is 46%. We should emphasize that the effects of financial leverage are not always obvious and consistent across different levels of profitability and debt proportions. Before recommending a specific long-term financing mix for implementation, it may be required to investigate these impacts. When the return on assets exceeds the cost of debt, financial leverage is advantageous. When the return on assets is high, the debt ratio causes the net return on equity and earnings per share to rise. But reverse is the case when return on assets is less than cost of debt. As a result, financial leverage appears to be a two-edged sword. It enhances the volatility of returns while magnifying them. Increased volatility means more risk in the event of a mounting interest burden, which is, if not fulfilled, could result in bankruptcy. And the riskiness of the company may increase in the eyes of equity shareholders and lenders. Operating leverage. The financial leverage as such multiplies the danger of bankruptcy. We now have a new concept of leverage which is closely linked to business risk, which I again explain with the help of an example. Here I have given the example of three firms, firm A, B, C. The fixed cost of firm A is 1.5 lakh, of B is 3 lakhs, of C is 4.5 lakh. Variable cost per unit is 7, 5, and 4. And here the calculations have been made. I explain one. In case of 30,000 units, in firm A, the fixed cost is 1.5 lakh plus variable cost is 30,000 multiplied by 7, 2.1 lakhs. And therefore total cost is 3.6 lakh. Sales at the rate of rupees 10 per unit for 30,000 units is 3 lakh. Therefore there is a loss of 60,000. In the same way, all calculations have been done. Here you will see, in case of firm A, the break-even point is the earliest, 50,000 units. While in case of firm B, break-even is at 60,000 units. But in case of firm C, it is somewhere between 70,000 and 80,000 units, or you may say 75,000 units. But The rate of increase is maximum in case of firm C. Means if the sales further increases, then there are more chances of profit in firm C. This has been given as which I have just told you here, and again shown in the form of graphs. Here you will see in case of firm C, the break-even point is latest, is the maximum, but the after that the increase will be greater. The effect of change in volume or net operating income, profits before interest and taxes, is measured by the degree of operating leverage. The following formula can be used to obtain this. Degree of operating leverage is percentage change in net operating income divided by percentage change in units sold or sales. This you may say also this percentage change in EBIT divided by percentage change in sales. Combined leverage. The degree of operating leverages and the degree of financial leverage can be mixed. In reality, degree of operating leverage is considered the initial stage of leverage, whereas degree of financial leverage is considered the second step. Financial leverage can be calculated using the following method, which evaluates the impact of change in EBIT on earnings available to equity share. Or you may say degree of financial leverage equal to percentage change in net income divided by percentage change in EBIT. In other way, you may say percentage change in EPS divided by percentage change in EBIT. The degree of manifestation in net income, return on equity, and earning per share for a given increase in sales is measured using a mixture of operating and financial leverage. When a company uses a lot of operating and financial leverage, modest changes in sales can cause big swings in net income, return on equity, and earning per share. The degree of combined leverage may be measured by using the following formula. Degree of combined leverage equal to degree of operating leverage into degree of financial leverage. Degree of combined leverage is degree of operating leverage, which I have just told you, percentage change in EBIT divided by percentage change in sales, or the ratio between change in EBIT to change in sales. Degree of financial leverage is change in EPS divided by change in EBIT, or relations of change in EPS to change of EBIT. Or you may say by this degree of combined leverage is percentage change in EPS divided by percentage change in sales. Or you may say relationship of change in earning per share to the change in sales. It is worth noting that different degree of operating leverage and degree of financial leverage combination can result in the same degree of combined leverage. If management has a target of degree of combined leverage, degree of operating leverage, or degree of financial leverage changes may be made to meet the target of degree of combined leverage. For example, if a firm's operating leverage is high due to the nature of its operations, the financial leverage may be proportionately reduced to avoid lowering the target combined leverage and vice versa. Financial leverage and risk. At the beginning, we discussed the concept of risk. The concept of operating, financial, and combined leverage have all been studied in order to determine the amount of risk, maybe business, financial, and combination, that the firms bears as a result of actions to adjust the various degree of leverage. Risk can be quantified by using a variety of statistical methods. Calculations can be performed for determining the risk character of firm in response to amounts of financial leverages stipulated. This analysis helps to plan capital structure. That's all. Namaskar.